Hey, it's Patti Scharf, CPA and co-founder of Catching Clouds, the leader in e-commerce accounting. Today I want to talk about something that a lot of S corporation owners either miss in the discussions with their tax CPAs, or it's not brought to their attention or whatever, but it is a huge red flag for the IRS, and this is reasonable compensation. So let's jump right on in. Just to remind everybody, we do not actually do taxes. This knowledge is really from a prior life. So I want to make sure that you guys are talking to your tax CPAs to get advice on your own personal tax situation. So what is reasonable compensation? So to really understand this, I need to give you a little bit more context. So I'm going to use an example. Let's say that you're making $200,000 as a sole proprietor. So sole proprietor is basically the simplest business entity type there is. You just say, hey, I am a business, and poof, you're a business, okay? So if you're a sole proprietor, you're filing on Schedule C on your individual income tax return, okay? When you are filing this, let's say you make $200,000, you're going to pay federal income tax, you're going to pay state income tax, and you're going to pay what's called self-employment tax. You're self-employed, you pay the self-employment tax. It's 15.3%, okay? You do get a deduction for half of that, yada yada. I want to keep this simple. So 15.3% is $30,600 if I did my math right, okay? Now, if you instead decide to file as an S corporation, you file an election, let's say you're a limited liability company, you file an election to be treated as an S corporation, okay? That has a different set of rules. And basically what an S corporation does, the IRS has basically said, okay, if you're an S corporation, then you as the owner really have two roles. You're wearing two different hats. One hat is the employee hat. The other hat is the investor hat. So as an employee of the business, you get to pay yourself wages. So you pay yourself just like any other employee. You're going to pay federal income tax on that money. You're going to pay state income tax on that money. But instead of self-employment tax, you're going to pay what's called FICA, which is your Social Security and Medicare tax, okay? And that is 7.65%. The employer is going to pay another 7.65%. If you add those together, it's the 15.3% that you were paying as self-employed, okay? I'm not going to get down in too much of the details, but this part is kind of important. With the other hat that you're wearing, you're paying yourself as an investor. An investor in the S corporation pays federal income tax, state income tax, but no self-employment tax, no FICA, okay? So hopefully you see where I'm going with this. If you're a sole proprietor, you're paying self-employment tax, so 15.3% on $200,000. As an S corporation, you're paying yourself, you're paying tax on 15.3% of only the employee's wages, okay? So if you're paying yourself $200,000, $100,000 as an employee, $100,000 as an investor, you're paying half the amount of payroll taxes, right? So there's an obvious incentive to the taxpayer to minimize the amount that you pay yourself as an employee and maximize the amount that you're paying yourself as an investor. The IRS is aware of this. The taxpayers are aware of this. And so the IRS is specifically looking for this on the tax returns. They're going to be looking for people who are not paying themselves wages. If you have zero owner's compensation, you are not paying yourself payroll taxes and doing that thing, the IRS is like, dude, stop defrauding us and we are auditing you and you will lose. That's it. So the IRS has this rule called reasonable compensation, which means you need to pay yourself a reasonable amount of compensation to take advantage of this tax break. So then the question becomes, what is reasonable? And if you go to your CPA and you say, hey, how much is that? How much can I pay myself where I'm minimizing taxes, but I'm flying under the radar? And all of the good CPAs will say, I can't tell you that. I cannot make that decision for you. You have to decide for yourself. So I'm here to give you a little bit of just guidance. And that is, what you want to pay yourself is what you would pay somebody else to do your job. It's going to end up being a little bit different for everybody because it depends on what kind of services you're providing to the company. There are just a lot of different factors at play here. So like, I might not pay myself as much if I am working 15 hours a week doing YouTube videos and have a team of people supporting me as I might if I was the one doing all of the work in the business as the only employee of the business. You see what I'm saying? So you have to figure out what is a reasonable amount for you. And the best way to do that is just how much would you pay somebody else to do your job? There's one other thing to keep in mind is the IRS will look at this over like a multi-year basis. So like if you pay yourself less in one year and you pay yourself more in another year to kind of make up for it, they'll kind of like cut you some slack and stuff on that. But I get really nervous when I see people who are like paying themselves $20,000 a year. Like, you're running the business. Like, this is your company. You can't pay somebody else to run a whole company for $20,000 a year. So I'd say just keep that in mind. Absolutely take advantage of the tax breaks for that if it fits your situation, but just don't take advantage of it. Just be reasonable. All right, so the next question is going to be, what payroll service should you use? And this is not a paid advertisement. There are lots of different payroll services to choose from. Choose the one that works for you, but I will tell you that I happen to love Gusto. We've been using it in our firm for 5 years with all of our e-commerce sellers, and I've heard nothing but rave reviews from other people as well for at least the last couple of years, okay? And let me tell you part of why they're so awesome. One reason they're so awesome is you can set it up for auto payroll. Like, you can just say, hey, pay me X number of dollars per month all year long. It'll automatically calculate it and run and deposit it in your bank and send the money to the government and file the payroll returns with the government, and you basically don't have to do anything. The next reason I like it is when you do that, you're paying your taxes a little bit over time, so you're not hit at the end of the year with this gigantic tax bill that you kind of forgot that you had to pay, and oops, you know, I meant to spend the money on this, but I spent it on something else. Like, it just kind of takes care of that for you and helps you help yourself. The next reason I like it is that as you grow and you have to hire more people, it's so easy to onboard new people. They've got like self-onboarding. You just like email the person that you're hiring. They'll send an offer letter. You can offer benefits, 401k and health insurance and like all kinds of different stuff. Like, it's a complete HR service. In fact, they will also, if you sign up for their concierge service, then they'll even like do employee manuals and be on call to answer all of your questions and everything else. So it's really one of those solutions that scales with you and it grows as you do and then shrinks down when you don't need it. You know what I mean? It's just super flexible, and they're awesome, and I love them. And they're not super crazy expensive. So yeah. So I hope this video helped you. If I wanted to do it in December in particular because I wanted to make sure that you had time to take action before the year ends. You don't want to like show up in April with your tax preparer, or March actually, because your returns are probably due in March, and not have taken care of this critical thing that needs to be taken care of for your business. So I hope you found this video helpful. If you did, please like, comment, and share. If you haven't already, please subscribe, and I'll catch you later.